So what are some strategies you can employ here with your portfolio and your investing style when you have a bear market or a market crash? So I'm really going to go over 3 options to look at to give you guys a better understanding of what you can do. Now, if you're still holding strong as an investor during this market correction, market crash, whatever we're experiencing right now, make sure to drop a huge like on this video because maybe if we get 150 likes in this video, that this bear market will end and we'll enter a bull market again. I think this video is actually going to help a lot of newer investors who have just started investing in the stock market. The more likes that we can get on this video, the more it'll actually be recognized by them. And don't forget to share this with family and friends as well. But either way, the first strategy here I would summarize as sell. So within this, you could actually be in one of 2 buckets, I would say. So the first bucket is you could have invested in these stocks, say a few years ago, and even with this recent 20% correction that we're seeing right now, you could still be up significantly on your positions. If this is the case, then you're in a pretty good position still. And what you could do is you could actually sell some of your position, take some profits off the table if you need the cash in the next couple of years, and there's absolutely nothing wrong with that. Now the second bucket here, which is a lot of you unfortunately, is that you got into the stock market in 2018, and after this market correction, your portfolio is now in the red. In this case, you're in a position now where fear is most likely starting to creep into your mind. But one thing you need to ask yourself, put everything aside, is are the companies that I'm invested in still going to be here in 5 years, 10 years, 15 years? Do I still believe that they will be around and doing well that far out in the future? Another question you need to ask yourself is, can I leave my money in this account, in these stocks, for the next 5, 10, 15 years and not need that cash for any big purchases? Now, if the answer to either of these questions is no, then you may want to go in and consider cutting your losses. But unfortunately, the way the market works is when you do decide to sell a stock, that's when you notice the stock will actually start shooting up and actually start making new all-time highs and all of that fun stuff. But try not to pay too much attention to it, make a decision and stick to it. But on the plus side, if you do cut some losses, you can always use that towards offsetting your capital gains tax. So that's kind of a plus that you can use there for your losses. Okay, the second strategy you can employ here is hold. Yes, hold. So again, this strategy will depend on your time horizon. But generally what I like to ask myself and ask other investors who question whether they should sell a stock or whatever is, do you need the cash in the next 5 years, 10 years, 15 years for something like a big purchase, maybe a house? If the answer is no, then what reason do you really have to sell? Why not just leave it in there if it's a strong company and just sit through this volatility until we do recover eventually? It really makes no sense to sell at a loss if you have a long time horizon. Even if your stock is down 50% from its all-time highs, chances are in the next 5, 10, 15 years, it will be higher than it is today, and it will be higher than its peak that it had hit maybe sometime in 2018 or 2017. But this is of course the case with companies that have strong fundamentals and strong balance sheets. Now realistically speaking, if these are strong companies, if you didn't hold and you sold a stock at a 50% loss, chances are, more likely than not, in a few years that stock would have recovered significantly and you would have been kicking yourself for selling out at such a huge loss. And not only that, most likely you would have re-entered the stock at a later date, missing out on those potential gains on that recovery, and you most likely would enter the stock again at a late stage cycle where it could potentially roll over and correct again. So just remember the psychology behind this. People always try to flood in when things are going up, but you should do the reverse of that and flood in when things are going down, because that's when you have the most potential upside. This is pretty much general market mentality, and I know it's difficult, and I know you want to cut your losses when you see red in your account. But what I challenge you to do is look at 2008, 2009, during that great recession, pick one of your favorite stocks with strong fundamentals, strong balance sheet, and see how it performed during that time. Of course, you'll see a lot of these stocks corrected 50, 60, 70% or even more. But if you fast forward to now, 10 years later, a lot of these stocks are up in the hundreds of percents. Now, even though these gains are not guaranteed in the next market correction or market crash, just remember that 100% of the time that we've had a market crash before or a market correction before, that the stock market has recovered and has always hit new all-time highs. And the third strategy, which I want to discuss with you guys, is buy. So of course you knew this was coming. So this right here is my favorite option personally, and it's what I'm doing as well. So during our market corrections, strong companies are on big discounts. Apple is down around 35%. Facebook is down over 40%. Alibaba is down over 40%. And these are all extremely strong companies with strong fundamentals, great moats, and strong balance sheets. And when you go shopping for something, say something like a brand new TV, which is regularly a $1,000 TV, but now it's on sale for 40% off, are you gonna go look at that TV and be like, I don't think I want this TV anymore because it's so cheap? And really, you can extend this logic. It's the same logic here with the stock market. If a stock is 40% off and it has strong fundamentals, why wouldn't you want to pick up that stock at a cheaper price? You can essentially see the stock as being on sale. And again, if it's a strong business, the ROI on that will most likely be pretty significant. So this strategy right here would involve you buying shares of stocks as it continues to decline. So as the stock price goes, say from 200 to 175 to 150 to 125, you keep buying chunks of shares here as it's going down. Say at 200, you buy some more at 175, you buy some more at 150, and eventually that'll lower your cost basis to a more reasonable level, closer to where the stock price is currently. And then when the market eventually starts to bottom out and starts moving higher, that's when you'll see your cost basis come into play. It'll hit your cost basis much sooner than it would have been if you just held at a higher level. And of course, as a result, you'll end up with much more gains than you would have if you just bought at say $200 and just held it there, as opposed to average down on the way down. So again guys, let's try to get 75 likes on this video if you enjoyed it. Let me know what strategy you're employing in the comment section down below. Again, me personally, I'm doing number 3. I'm buying more stocks on the way down here, but I'm curious to see what you guys are doing. Either way, thank you so much for watching. Hope you enjoyed this video. Don't forget to invest positively, and I'll see you in the next one. Peace.